Good morning, everybody. I hope I'm audible to everyone. Okay, great. So, a very warm welcome to each one of you joining us today. I'm Smriti, your host for the second edition of SSW Navigator, an exclusive investor education initiative by Shubshanti Wealth. Education has always been central to our core mission and in our endeavor to reach as many people as possible, be it a client, be it an investor, or simply someone eager to learn. We created this series of webinar to connect you with industry experts and their insights on various important topics. Last month, we kicked off this journey by decoding small cap funds, and I hope that our debut session brought you some valuable insights and market clarity. In today's session, we have with us Mrs. Amrita Mohanty, Chief Learning Officer of Sundaram Asset Management Company. She is a seasoned professional with over 21 years of experience in the banking and financial services. Prior to joining Sundaram AMC, she led the Learning and Development Department of White Oak Capital Group. And before that, she was the head with Franklin Templeton Academy. Along with her, we have Mr. Sandeep Chhajer joining us today, founder and CEO of Shubshanti Wealth, who has spent more than 2 decades in the financial markets. Now, before I hand over the spotlight to Amrita, I would request Sandeep to set the context for our discussion today. Over to you, Sandeep.
Uh, Thank you, Smriti, and thank you everyone for taking out time today. Let me begin by asking you something not about markets, not about returns. Right now, with missiles in the Middle East, drones over oil fields, Ukraine 4 years into a war, what is going through your mind about your investments? Because I have been advising investors for 20 years, I can tell you exactly what investors are feeling right now. I know because my phone has not stopped. Should I move everything to gold? Should I stop my SIPs? Is this time different? I've sat with people who have built wealth over decades, quietly, patiently, and I've also watched some of them make decisions in one panicked moment that undid years of disciplined investing. Not because markets did not recover, they did every single time, but because fear moved faster than logic. The investors who stayed calm during COVID, when Nifty fell 30% in just 3 months, went on to see lifetime highs. The one who exited is still waiting to find the right moment to get in. That gap between what market delivers and what you actually earn is not created by the war. It is created by something in the mind in that moment of fear. And to understand that gap and closing it is exactly what today's session is about. With that context, I would like to invite Mrs. Amrita Mohanty to share her insights and deep understanding on the same. Over to you, Amrita.
Thank you, Sandeep and Shubshanti team to have invited me for the session and selecting a wonderful topic. And we had a lot of ideation and brainstorming as to what are the important and critical points we will leave forth in front of this August audience. So big thank you to Sandeep and his team for inviting me for today's session. So I'll quickly share my screen. Kindly let me know if my screen is visible to all. Yeah. Sandeep, can people see my screen?
Yes, we can see.
Yes.
Excellent. Thank you so much for letting me know. And I hope my voice is loud and clear.
Absolutely.
Wonderful. So, a hearty welcome to everyone. Good morning to each and all, and for joining in for enhancing your knowledge as to whether our decisions are distorting our wealth creation journey and how can we avoid them. And let us start with a poll. And here you have the QR code You can see the QR code. We are also posting the survey link on your chat box. Kindly participate in that survey. It has only one question. And the question is that in a lake, which has a patch of lily pads, every day the patch of lily pads is doubling in size. So if it takes 48 days for the patch to cover the whole lake, how long would it take for the patch of lily pads to cover half of the lake? So just to repeat, there is this lake which has some lily pads around it, and the lily pads are growing, by leaps and bounds and covering the entire lake in 48 days. If it takes 48 days for the entire lake to be covered with this beautiful, lily flowers, how many days will it take for this patch of lily flowers to cover half of the lake? So is it going to be 24 days? Is it the answer option number two, which is 47 days, or is it option number three, which is 12 days? So please feel free to chip in your responses, and we would love to hear you. What are your thoughts? And so nice to see almost 11 responses submitted so far. But we would encourage everyone to take the poll. We are not looking at the efficacy of your answer, but your participation matters a lot to us. Here's the QR code. You can also scan the QR code, and the link has been pasted by the Shubh Shanti team. So we are getting wonderful responses. 47% of this audience feels that it's 24 days. 44% of this wonderful community of investors feel it is 47 days. And then 15% of our participants, or 13% of our participants, so to say, are gravitating towards 12 days. And we've received 22 responses, 23 in fact. While I'm completing my sentence, it's gone up to 25 responses. Excellent. We'll give few seconds time and we'll close this poll. Okay. Great. So please keep giving in your responses. I'll flash the poll results even at the end of the session. But thank you for participating. That's number one. So the correct answer is, a lot of us said that the correct answer is that if it takes 48 days to cover the lake, it will take 24 days to cover half of the lake. That's how we think. But if we take a deep breath, hold back, take a pen and paper, and actually start calculating, put a thought around it, a logic around it, which all of us have. We human beings have human intelligence abundantly in all of us. And if we take a pen and paper with us and try to understand that what's the correct answer, and here is the logic. And the logic is that if every day this patch doubles in size and the lake is fully covered on the day 40th, 48th, then on 47th day, it would have been half covered. So if it takes 48 days for the entire lake to be covered, which means 47th day, it is half covered. So it will just take one day for the entire lake to be covered because the patch of lily pad will get doubled. So it doubles in its coverage every day. So 47th day, it's half covered. It will just take one more day for doubling. So the answer is 47 days. Now, why are we asking these questions? And these are called cognitive reflection tests. And this kind of questions were administered to very intelligent students coming from premier institutes all across the globe. And yet, a lot of them failed to give the correct answer. And the reason is that brain is a machine for jumping to conclusions. We give impulsive answers. We are reactive in nature rather than being responsive in nature. And brain being a machine for jumping to conclusions was given by Daniel Kahneman, who's considered to be the father of behavioral economics, and has written a fantastic book called Thinking Fast and Slow. So therefore, the objective of today's program is, before we plunge into understanding biases, and by the way, there could be 100, 200 biases, but we are going to focus on three or four critical biases that impacts our decision making. But it all stems from where we are deciding. So if brain is a computer, it has two operating systems, system 1 and system 2. And we are going to first debunk, understand, demystify what do we mean by system 1 modality of thinking, what do we mean by system 2 modality of thinking. While Investing biases, behavioral biases can be plenty, but we are going to look at four critical ones. There could be some more, and if an opportunity is given to me in the future, maybe we would like to explore them. But currently, these are the essential ones, considering the landscape of geopolitical tensions that is enshrouding us. And then we will look at the experiential nature of behavioral economics, behavioral biases. This is the maximum we can speak over a lecture, but it has to be experienced. And therefore, we will delve into how to mitigate these behavioral biases and the experiential nature about completely grasping the essence of the mistakes that we commit. So a bit about cognitive reflection tests. So they are these simple tests. It could be a bat and a ball. A bat and ball is worth $1.1. Bat is $1 more than the ball. What is the price of the ball? So these kind of trivial questions, the questions around lily pad, how many days it will take for the lily pad to cover half the lake? And a lot of us said 24 days, but the actual answer is 47 days. Just one more day, it will be required to, double and cover the whole lake. So these kind of trivial questions, which are actually easy, the lily pads and the bat and the ball and many other things, the widgets of the world, were called CRTs, cognitive reflection tests, given by a famous psychologist called Shane Frederick. And he wanted to assess, people's tendency to override. Are they able to override an intuitive response, an immediate response, or are indulging or contributing towards a deeper reflective thinking? So therefore, this kind of test was administered, as I was telling earlier, to students studying in the creme de la creme universities of the world, the Harvards and MITs and Princeton's universities of the world. Yet, 50% of them gave incorrect answer. Now, they gave incorrect answer because it was an impromptu answer that was given. It was not a well thought through response. It stemmed out of impulsiveness. It stemmed out of intuition. It did not stem out of logic. So cognitive reflection test actually gave birth to two modalities of thinking. So if your brain is a computer, it has two operating systems, system 1 and system 2. Now, what is system 1 and system 2? System 1 is when we are intuitively doing something. Like you take the same road to commute. You know the in and out, the lanes very well. That's how an auto rickshaw driver would do. Versus using a Google map. Versus actually studying what is the traffic intensity at a particular time in your city, in that road, and then taking a concerted call. Now, when we are studying Google Maps, studying the intensity of traffic, we are utilizing system 2. When we are taking a decision out of our gut, that's system 1. So a simple calculation, 2 multiplied by 2 is a no-brainer. We are not using our higher mental faculty. We are giving an instantaneous answer, which is 4. But if we have to do a computation, which is 12 into 24, it will take some time, which is 288 is the answer. It will take some time. So system 1 is the reason why we succumb to panic and hype. So when the markets are doing very well, everything looks hunky-dory, everything looks rosy. We would want to invest into the latest stock, the latest mutual fund scheme, the latest IPO, etc. When there are market crashes and volatility into the system, our impulsive brain tells us, redeem. No longer we need to be into market-linked products. Let's get back to fixed deposits. So when markets are down and your gut is saying that let's redeem, that's system 1 in action. Now, system 1 is based on guesswork. It's based on shortcuts. Now, it's based for lower tasks. Like, if we have to brush our teeth, we don't have to think. But if we have to prepare for CFA exams, we need to study a lot. We need to do a lot of preparation. So blindly chasing any NFOs, chasing any hot trending stocks, getting into exotic assets, which does not have any intrinsic value, or we do not know the fundamentals. Now, that is stemming from a very fast, instinctive mode of thinking. System 2, on the other hand, is deliberate, very analytical. You are taking a decision by understanding all viewpoints, the points that supports a particular investing avenue, up the various other points that are not supporting the investment decision. So it's effortful, it's slow, it's deliberate. So when you are actually dealing with Shubh Shanti and understanding what is your risk appetite, what are your financial goals, how is it that you're going to achieve your financial goals, translate your aspirations into financial reality, that is system 2 effort. When you view corrections as an opportunity to invest and embrace the fact that volatility is part and parcel of equity investing, and you actually make that decision by analyzing a lot of data and facts, that's system 2 thing. Checking out risk adjusted returns of funds, rolling returns of funds, and looking at the consistency, credibility, and how the fund has been consistently delivering you alpha. Alpha means excess return of the fund versus the benchmark, and engaging with a expert. Because if for example, if I'm having a fever, I can have a Dolo 650. But if I have a paracetamol tablet, but if I feel that it is beyond fever, I have to go to a doctor. I have to get the diagnosis done. I have to understand what's wrong with me. Now that's where not everything is Google search and chat GPT. We have to consult experts. We have to consult financial advisors because that is their job. That is what is their occupation, their profession. They're experts. And when you're consulting experts, that's also a system 2 thinking because you're engaging with experts who are already adept at system 2 thinking. So therefore, I like to ask you a question. Please use the chat box and place your answer. By the way, the entire program is interspersed with lots of trivia questions and knowledge checks. So we want, again, a lot of your interactivity and participation. We don't want it to be a one-way highway. Now, I'm asked, there is a question on your screen. We have seen Sensex and Nifty correcting. We have seen 1,000, 2,000 point market correction in the recent past. So assume you're seeing that, there is a 1,700 point crash in Sensex and 7 lakh crores of wealth has been wiped out from the capital markets. What will be your reaction? Should we consider redeeming our investments from equity mutual funds? Or is it option number 2, where should we be assessing the reason behind the market correction and evaluate whether it has opened a few favorable valuation and quality opportunity? So what will be your mode of action or your mode of thinking? Will you be just redeeming everything, thinking that it's doomsday, it's world war, the world is coming to an end, everything is in a pitiable position? Or will you take a deep breath, assess the situation as it is, look at the pros and cons, and then take a decision that suits your investment objective? Which is the path that you would be embracing? The path number 1 or path number 2? So I'm getting a flurry of responses. Robin says it's option number 2. Shrimati says it's option number 2. Nandita, Amol, Ayush, Sunita, wonderful. Thank you so much for your participation. It means a lot to us. Yes, I would rather being tensed and jittery and panicky mode. I would rather look at what are the reasons for market corrections. Who are the participants who are redeeming from the markets? Who are the players who are supporting the markets? Now, has anything changed about our companies? If the companies are posting profits and earlier their share prices were on the higher side, today I'm buying the same company at a lower price, which means the valuations have become attractive. And if there are quality investment available and there are certain schemes that are investing into such qualitative oriented companies, then should I be looking at investing in a staggered manner or actually investing at this juncture? So we have to ask ourselves, number 1, keep calm. Then number 2 is is our thinking driven by system 1 or system 2? System 2 means logical, analytical, calm, cool, doing a lot of research and taking your action. Checking valuation parameters. There are various valuation parameters like price to equity, price to book value. Price to equity means for every 1 rupee profit that the company makes, how much price you're willing to give to acquire that company's shares. Now, these are all technical ratios for which, again, I would urge contact the good offices of Shubh Shanti. there are so many parameters to be looked at to gauge the attractiveness of equity markets. And number one, is it impacting my goal? Now, if I am convinced that we have seen these kind of wars and market volatility even in the past, yet I've been able to achieve the amount that I was endeavoring to save for taking care of a certain future expense, then should I be worrying so much? Is it really a catastrophic apocalypse situation, or is it a passing phase? So this is what requires deliberation. So if I were to be in your position, I would rather switch to a system two modality of thinking rather than system one. So when we are taking a lot of impulsive decisions emanating out of our gut feeling, we are acting impulsively, we are taking shortcuts. Taking shortcuts, thumb rules and something which is not thought through well. They are called in a technical language in the world of behavioral economics as heuristics. And these are the emotions, these are the shortcuts that leads to behavioral biases. As I was mentioning earlier, behavioral biases can be plenty, but in this program, we are going to look at loss aversion bias, herding bias, confirmation bias, and availability bias. So, loss aversion bias. Again, the chat box has been activated. We would love to seek your responses. So let me ask you another trivia question. And the question is, which option would you choose? If you had two options. Number one is get 90,000 rupees for sure. Or the number two option is there is a 90% chance to get 1 lakh. Now, which option will you choose? Something which is like, I'm getting 90,000 for sure, or I might have a 90% chance to get 1 lakh. Which one would you be choosing? So I'm getting a lot of responses. Sayak says it's option number one. Ujwal says it's option number one. Saurabh again feels it's option number two. So when we are given something which is deterministic, it has a surety angle to it. We would want something that it's better to get 90,000 than dabble with the probability of getting 1 lakh, where there is a 10% chance that we may not get anything. So when this question is asked, usually we get response that we would go for option number one because there is a certain certainty and surety about the outcome. Now, let me flip the question and ask you another question, which is similar but on a flipped format. And the question is, now which option would you be choosing? Lose 90,000 for sure? Or option number two, take a 90% chance to lose 1 lakh. Now, this is basically a scenario of loss. Are you okay losing 90,000 for sure in totality? Or are you okay to dabble, to get into a 90% chance to lose 1 lakh, where there is a 10% chance you may not lose anything at all? Now, which option will you be choosing? So the decision is unanimous. Be it Sayak, Sunita, Shimanti, Nandita, Kushal, we are choosing option two. Very few people, would have chosen option two in the first question and option two in the second question. When it came to question number one, we went with a deterministic choice, something around surety. But the same surety, when it was presented as a loss, nobody likes to lose. Losing 90,000, it's bad. We've become a loser. So we want to get into a probabilistic choice. ठीक है ना, 10% चांस है कि 1 लाख रुपए मिल जाएगा, 90% चांस है कि कुछ नहीं मिलेगा, 10% चांस है कि we will not lose anything. Not 1 lakh मिलेगा, 10% चांस है कि we will not lose anything. Now we all want to trade, we all want to gamble. So when it comes to loss, we don't look at a surety wala choice, we look at a probability wala choice. We want to take the gamble. कि 10% chance hai, 10% chances there, we may not lose anything. So why is that? So in fact, you still have a 10% chance that you won't lose anything. And that is what a lot of people feel. I still have a 10% chance that I won't lose anything. But you also have a 90% chance where you can lose 1 lakh, right? So all of us feel that we will be into that 10% population. But a lot of us also should realize the fact that we can be in the 90% population also. So what if we are in the 90% gang, we lose 1 lakh, we lose 10,000 rupees more. We all feel that we are lucky, nothing can happen to us. Good, bad things happen to others, but not to us. So we all feel that we will be cushioned in that 10% wala density, not in the 90% cohort. Now, the reason is we are not choosing a sure shot losses, loss hurts. So there was a lot of study done, and it's called the prospect theory, that the emotion attached to losing is far graver, far bigger than the emotion attached to winning. So a lot of us, if not all of us, dislike losing over liking, right? Losses loom larger than gains. So I always ask this question that assume you're seeing Olympics, say Olympics swimming competition. There is a gold medalist, silver medalist, and a bronze medalist. Which sports person is the most disheartened? Obviously, it's not going to be the gold medalist because she has won a gold medal. Is it the silver medalist or the bronze medalist? Who is most disheartened in an Olympic, sporting activity? So a lot of people say it is silver medalist. Yes. So the bronze medalist is happy that he's in the top 3 rank. The gold medalist has already won. It is the silver medalist who's the most disgruntled. Why haven't I'm stuck in between? I'm not I've not won the gold medal, so he's quite disgruntled. So why am I giving this example is that a lot of people hate taking losses. So if your portfolio has 100 rupees gain, you feel that fine. But if your portfolio shows 100 rupees loss, a lot of us overreact. Oh, how could this happen? The world is cruel. You've invested into 10 funds. Overall, the fund has given you a 15-25% CAGR. You're very, very happy. But within that portfolio, you've seen one scheme that has given you a negative 1% return. You're quite unhappy. You forget about the other 9 schemes. You're just focused about why this fund gave me a negative return. Now, funds go through fluctuation. They're all market-linked products. There have been many instances where my SIPs, maybe for 1 year, 2 years, have given me negative returns. But I continued the journey. I stuck to my rigor and discipline and embraced a financial goal-based approach. And the rest is all history. Today, when I look at after 10 years, my account statement, they have my investments have beaten inflation and they're giving me wealth. Now, coming back to your question as to, why wouldn't I want to take a 10% chance? But why do you think you will be in the 10% population? It could be that I could be in the 90% cohort and I could lose 1 lakh. So we all think that we will have a slim chance to escape because that's how movies are made. That's how serials are made. That's how Netflix series are made. That's how our heroes are shown. They're taking that chance and, the chance worked. Not always luck will be in our favor. We could be in the other part of the table where we are quite unlucky. So what if, I take the probability, I take the chance of not losing anything, but I belong to the other gang and I lose not 90,000 but 1 lakh. So we have to look at this. So there is no right or wrong answer, but the fact is that when we do this activity, predominantly people go for the option number 2 because there is a slim chance. Nobody wants to take a 90% loss for sure. We want to play on that slim chance. Now, this is what is loss aversion. So loss aversion means the pain of losing is psychologically twice as powerful as the pain of gaining. And it emanates from a part of our brain called amygdala. So if you look at the brain, there is a prefrontal cortex, there is a limbic brain, there is a very tiny portion of our brain called amygdala. Now that's called the lizard-sized brain. And this is the brain that actually, is always on a survival mode. This is the brain where it sees a lot of danger, either tries to escape that danger or fight that danger. And it all comes from social conditioning, from our prehistoric ancestors who saw a saber-toothed lion attacking them, and they were all either in an attacking mode or an escaping mode. So today we don't have tigers and lions roaming on the streets, but the tigers and lions that can impact our psychology, impact our decision making, impact our emotions is social media, is news. Are those breaking news? Are those, newspaper snippets which actually exacerbates the situation more out of its reality? So, so again, we need to check that, are we getting over influenced by what is flashed to us? Because we live in an information overload era. So, what are the repercussions of loss aversion bias? Is that, again, we have to check, are we taking decisions from amygdala, which is system one thinking? And if it is system one thinking, we'll resort to panic selling. We'll fail to stay invested for the long term. We'll abruptly move out of equities. We'll over allocate into gold ETFs and silver ETFs. But if you look at the actual standard deviation, the volatility of gold and silver listed prices, they're as volatile as equity. So if you have a portfolio with only commodities, you're inviting a lot of volatility into your life. So asset allocation, prudently sitting down with your financial advisor and allocating money into different investment options is required. A lot of us will pause our SIPs, stop our SIPs. That's not the best thing to do. The best way to create money is amnesia. Just forget about it. Have a 10-year SIP, just forget about it. And that actually creates a lot of wealth. Avoiding additional investments when the valuations are lower. So loss aversion actually leads to endowment bias. Sometimes I've seen a lot of investors, including my own father, having that LIC ka insurance policy that has not given any returns. It's a traditional investment policy. It is just lying like that. It would have given 4-5% return, and he doesn't want to relinquish it. We might have a patch of real estate somewhere. It's not appreciating at all. We don't want to sell it off. We might have some shares which we would have bought it at 100 rupees. Today, the value of those shares is 10 rupees, and we don't want to relinquish it. We in the hope that things might recover and situations might change. So loss aversion also leads to holding on to losing investments. As long as any investment is on paper, it is fine. The moment losses gets converted into a reality, we don't want to face those losses, and that's called the endowment effect. Yeah. So endowment effect is reluctance to accept. Sometimes we would have made bad investments. We don't want to let go. So not wanting to let go of bad investments is also called endowment effect. So how do you reduce these biases, especially loss aversion bias, which is a classic case of system one thinking? Is stay calm, delay your decision, think over it. The fact that this bias exists is number one step towards reducing this bias, overcoming this bias. Always gather key facts, take informed decisions. Imagine what can be the worst case scenario. So when I invest into equity, I look at the rolling return data. And I look at the rolling return data of 10 years, 15 years, 20 years. And I want to know what is the worst return equity has given. So when I look at a 15-year data of equity, the worst return is 9%. The best return is, God knows what, it is 40-50%. The median return is 16-17%. That too for an index. If I'm getting into an actively managed mutual fund, I know it will give me some 1%, 2% more returns. I'm fine with it because that 9% worst return on a 15-year time frame is also beating inflation. So imagine what could be the worst case and can you live with it? So these are some of the things. Now, I'll give you an example of COVID tantrums. Now, if an investor had done SIP in 2015, a 5-year SIP during COVID times, even a 5-year SIP was negative. So imagine an investor had started an SIP in 2015 for 10,000 rupees per month. The value of that SIP, that investor would have saved 6 lakhs odd. The value of that SIP was 5,35,000. There was a 3% loss. Right? So 5 years SIP you have done and it has not reaped any results. Right? And there is a 75,000 rupees loss. Now, there were investors had two choices, two paths to take. The mutual funds and SIPs are all hogwash. Indian capital markets is all scam. I don't believe in all of that. Let me say tata bye-bye to all mutual funds. Let me go back to my good old post office savings and NPS and fixed deposits. And I'm not saying those are bad avenues. Every avenue is good. We have to ascertain returns in terms of safety, liquidity, and inflation beating capability. So safety, most of these products are regulated. But what's the point in getting into a PPF where I get 7% and inflation is also 7%? Right? What's the point in getting into over allocating, not just getting over allocating. The point is over allocating into NPS, where before 60, I will just get 20% of the lump sum amount. So we have to look at how liquid that investment is, whether it is, and it's not about not looking at those products, but judiciously, prudently allocating money. So coming back to this scenario, the scenario was two paths. One path is stop and redeem the SIP. The next path is continue your systematic investment journey. Now, what if the investor took path number two, continued his SIP for 5 years more? Here are the results. One, he saved more because he continued, right? He didn't disband his SIP's journey. Instead of saving 6 lakhs, he saved 12 lakhs. And the value is 23.4 lakhs, which is a 13% return. And that too, I'm talking about an index. We invest not into, I don't invest into index funds. Most of my funds are actively managed into good fund houses. Have they given me more returns? Obviously, they have given. So the moral of the story is same, aim for the big picture. Focus on creating your 24 lakhs wealth, 23 lakhs wealth, rather than fretting over a short-term intermediate loss of 74%. Now, well, you might say that Amrita, COVID is 5 years back a story, right? Yes, we appreciate that during COVID era, during that January, March COVID situation, markets tanked by 30, 40%. But what about now? You know, the situations are very grave. There is a lot of tension in Middle East. Never did we imagine that our favorite cities like Dubai and Abu Dhabi will get bombed, right? So let's look at the current situation. Now, how Sensex has reacted to major wars, terror attacks, etc. Now, be it Gulf War or 9/11 or Parliament attack or the US invasion of Iraq or Pulwama or Russia, Ukraine. The day when the war started, now 5 days into the war, Sensex was negative. But 90 days after the war, 3 months after the war, Sensex had recovered. And most of these wars are imported wars, except for the Kargil one, which was, we saw infiltration of terrorists into our country, the Parliament attack, right? The recent Pahalgam attack. A lot of wars germinated outside of the Indian soil. So you might ask me, Amrita, theek hai, teen mahine baad, so they have all recovered. How about 1 year, 2 year, 5 year? What is the market returns after the war? What is the market returns for a longer period of time? So now, be it Kargil war, and I'm taking the case of an unlucky investor who started investing on 6th May 1999, the day when Kargil started. 1 day returns was pretty bad. Pretty bad, matlab, Sensex would have corrected by 200, 300 points. But it's been almost, you can see, it's been quite a long time. It's been 25 years since Kargil war. And war happened, and we've seen Nifty 50 giving you a 13% CAGR. 5-year return was 12%. Now, Iraq-US war, we invested exactly on the day. We were the unlucky investor. We invested exactly on the day when the war started. It's been almost 2 decades since the war. 1 day returns was bad, but few months later, Indian equity markets had recovered. And 21 years ka CAGR is 16%. I'm not even talking about 5-year CAGR, which looks pretty attractive. Russia-Ukraine war, yes, it hit us hard. 1 year returns was negative, but 2 year returns, 2.5-year return is 14-15%. Israel-Hamas, 1 year return, 26%. Which means that there will be many reasons for markets to correct and many reasons for markets to recover. India is a story altogether. It's a consumption-led economy with a median age of the population to be 28 years. It's a giant elephant. Even if it makes small strides, it actually has huge impact. While there are so many things, miles to go before we sleep, we can create a lot more employment opportunity. We can do a lot more things in the world of AI and science and technology. But a lot of things that has happened has moved our country. We are not Japan. We are not an aging economy. We are Atmanirbhar. We consume for ourselves. That is why the thinking is, the ideology is make in India, make for India. That's what the recent union budget has also spoken about. So coming back to wars, Indian equity markets have been immune from war effects, right? Because a lot of these wars has emanated outside of our country and not germinated within our country. Sandeep, you wanted to ask something to me? Please go ahead and ask. Is my pace fine? Is it all making sense? Am I going too fast? Please let me know,
Ye-
audience. How are you feeling? If it is nice, give me a chat or give me a thumbs up on the chat box. Yeah,
Yeah, thank you, Amrita, and it's been wonderful so far. What I wanted to ask is the last part of the slide that you share on the endowment effect.
yeah,
A lot of investors hai na, invest in stocks directly and they find it very difficult to book losses. However, if they have made a good bet, it's very easy for them to book their profits. So,
yeah.
how can we address this behavior through loss aversion bias and what should they do?
Okay, so see, when we are investing directly into stocks, we
Hmm.
need to ask ourselves, why have we bought it? Is it because our friends have invested into it? Were we part of the FOMO effect, fear of missing out? What is FOMO effect? We see that a particular company, a particular fund, a particular scheme is getting heavily advertised. We see, people around in our society, our neighbors investing, our relatives investing into it. And we feel that we should not be missing out that opportunity. So the question starts with why. The second is, when it comes to stocks, even I had invested into Zomato during the IPO times. And I'd invested at 40 rupees, it's worth 300 today. Have I made returns? Definitely yes. Have I made wealth? Absolutely no, because I'd invested just 4 shares into Zomato. Now, 4 shares, looking at those stories, if you would have invested 1 share in Infosys, your Karodpati today hasn't made me Karodpati at all. So my investment maybe is worth 3,000 rupees. It's not worth 3 crores, right? So when it comes to stocks, we have to look at the 3M formula. What is 3M? What is the model of that company? What is the business model? The market, the consumers, who are they? Is it an addressable market? So the 3M is, what's the business model? What's the addressable market? And the final M is, how good is the management? Now, these and all, your Claude and ChatGPT and Perplexity can give you wonderful stories, but you still need an expert. You still need a qualified research analyst, a financial advisor to take decisions. So when it comes to taking any investment decision, we have to ask why. So I am also an educator. I'm very much into the BFSI sector, and I've invested into a lot of schemes. But the best advice came from a financial advisor 20 years back when he said, Ki Amrita, nothing doing. You have to give me a 2,000 rupees ka investment into a perpetual scheme. I forgot about it because 2,000 rupees, any which ways, I would have splurged it in Sephora, in some mall, right? Bought some clothes for myself. I forgot about it. One fine day, I got an envelope which had the account statement, and my eyes popped out. For 20 years, 2,000 rupees means I had saved 9 lakhs, and the value is 40 lakhs. Now, 40 lakhs gives any investor a lot of confidence. Now, is that fund the best in the industry? No. It is, in fact, the most average fund. But my behavior of continuously doing that SIP and my behavior, I should attribute it to my forgetfulness, which created wealth. So, Sandeep, to answer your question, when we are buying stocks, we have to look at the 3 models. 3M. What is the business model? Is it an addressable market? Is the management good? And investing in stock is serious business. It has to be outsourced to an expert financial advisor or to a fund manager. Am I making sense?
Yeah,
Sandeep,
yeah.
does that answer your question?
Yes, yes. Thank you so much. So, Amrita, since we're running short on time, what I'm going to do is I'm going to reserve all the other questions towards the end of the session, and you can continue
Sure,
the session for now.
sure.
Okay, fine.
Now, what is herding bias? It's also called the bandwagon effect. Now, it is, what the question that was asked, FOMO mentality. Everybody around me is buying the same stock, investing into the same sector, investing into, the same gold ETFs and gold. Let me go and invest. So putting money into the same product sector scheme because everybody around you is doing it is called the FOMO effect, fear of missing out. that overrides rational analysis. Copying others is what creates bubbles, unnecessary risk, prevents building a suitable portfolio. So the example is during the COVID time when all of us were working from home and video conferencing platforms became very popular. Um, People wanted to buy Zoom ka stock, the very platform on which we are conducting this training session. And investors in the US bought the wrong Zoom. Now, there were two Zoom companies. One was Zoom Video Conferencing, which is the platform that we are using today. The other is called Zoom Technologies. And investors did not even see that whether they are buying the right Zoom stock, and everybody started buying Zoom technology. So buying the wrong Zoom stock. Sometimes it's better to be lucky than smart. And in a frenzy, they bought the wrong Zoom stock, which appreciated by 1,800%. And the regulator there, SEC in the US, had to halt trading. Now, this happened in the most advanced market. People buying the wrong Zoom. And why? Because video conferencing platforms were quite popular that time. And in a frenzy, doing anything in a frenzy with the modality that we don't want to miss out is called herding bias, copying the actions of others. Now, Indian example is the IPO craze. Several investors bought Paytm, Nykaa, investors rushed in. And Paytm was listed at a very, not that I'm against the stock, I'm just saying the frenzy, the hype, the euphoria around, the excitement around buying something. It was listed at a very high price. Herd mentality drove many to invest into this at very, very high valuation. Later on, the stock crashed. So there are plenty of stories, be it in the arena of cryptocurrency or anything. Buying not because of the fundamentals and qualitative aspect of an investment, because everyone else is doing it. That is herding bias for you. So the way to handle herding bias is take a pause. Ask, does it truly fit your goals? Research, think independently. Popular does not mean it is right. Just because something is covered in the media, something is popular does not mean it is right for your portfolio. So do your own homework, take a contrarian opinion. What can go wrong? Pause. Those are the ways to reduce herding bias. So reflection is, ask yourself, am I investing because it is trending on social media? Am I panic selling because everybody else is redeeming out of equity? Do I regret missing out an investment only because others have made money? If you get a lot of yes to your answer, it means that herd is influencing you. Herd mentality, herding bias, bandwagon bias is influencing your financial choices. The third bias is confirmation bias. Please use the chat box and give your answers. And the question is, Ravi bought shares of a company because he strongly believed it has bright future. After investing, he only watched positive YouTube videos about the company, ignored negative news reports, kept telling himself market will soon realize its true value. So he bought some shares because he truly believed it. He watched only those YouTube videos that was praising the shares. And he kept telling to himself कि नहीं मैंने तो बहुत अच्छा share खरीदा है. He ignored all the negative news, right? So first of all, is he showing a bias? Do you think he's showing a bias? And if you think he is showing a bias, which is that? Is it loss aversion? Is it confirmation? Is it herding? So a lot of people are saying, Robin is saying it is herding. Srimati says it seems to be a confirmation bias. Ayush says it's a herding bias. It is a confirmation bias. Sometimes we have a favorite child in the house. I was the second child of my family, and I would get away with a lot of pranks. I would just cry, and instead of me being scolded, my elder sister was scolded. So parents have confirmation bias. We have confirmation bias. What do we mean by confirmation bias? We only want to consume positive news about something because we are biased towards something. We ignore the red flags. This is called a filtration bias, looking at the world with an illusive mindset, illusion-oriented mindset. Selective filtering of facts, then favoring information that confirms your belief, ignoring what contradicts those beliefs. For example, there is an investor who believes fixed deposits are the best. So he's only going to read those articles that favors FDs is the best thing that has happened on planet Earth. And if he reads the report that equity mutual funds are risky, he will be very happy. He will say, look, didn't I say that equity mutual funds are risky? I've always thought that bank FDs are the best in the world. He will ignore all the data around equity. Similarly, if somebody is only into equity mutual funds, will ignore all the data around other investment classes. So are we consuming information that supports our belief and contradicting information that is not supporting our belief? And that's very, very important because it stems out of our ego. It stems out of our adamancy. The ramification of confirmation bias is we will only hold on under diversified portfolio. We've born into a family where we have seen our fathers investing into real estate. We only invest into real estate. We are born into a family where we have seen our parents working in IT companies and buying their company ka TCS ka shares more. Then we will only buy IT stocks. So that is called confirmation bias. Investing into sector and stocks where we are employed. So I remember in my earlier company that I worked in, I only invested into schemes of that company. Did I have confirmation bias? Of course, yes. So frog within the wall, we think that frog in the well, we think the well is our world. We only praise the well. We don't look at the external world. So frog in the well is a classic example of confirmation bias. We will have our own predetermined screens, 5-year returns for 52 weeks high, 52 weeks low, dividend yield. Says who? Are they properly validated screens to determine whether we need to invest into some products, some stocks, some schemes? So when we have frigid ideas, we stick on to that frigid ideas. We do not look at the red flags that can come out of those frigid ideas. That's called confirmation bias. And the way to reduce confirmation bias is always cross-verify details. Do not desensitize bad news about a firm, right? So anything, always, whatever decisions we take, like Gautam Buddha says, validate, follow the middle path. Look at the good news, look at the bad news. Do not desensitize anything. Avoid all these pre-existing screens. If you have done a proper course on CFA, on research analysis, that's your passion. Then do a fundamental research. Just because, a Claude or a Grok is telling me that these are the ways to select a stock, I'm not going to select stocks based on some existing screens and filters. I'm going to question their existence. So asset allocation, seeking expert guidance, diversified portfolios are the way to reduce confirmation bias. Now, the last bias before we call it a wrap, again, please use the chat box and give your response. Which amongst these causes the most deaths, the most casualties, the most fatalities? Is it accidents? Is it terror attacks? Is it brain strokes? What is it that causes maximum fatality? Accidents, terror attacks, brain strokes. So a lot of them are saying it is accidents. I'm glad that Ayush says it's brain stroke. And I'm so surprised and happy that none of us are saying terror attack. That means there is some positive impact about the session on, behavioral bias that we are speaking about. Yes, you are right. It is brain stroke and accidents that cause maximum number of fatalities, not terror attacks. So just because we see missiles getting fired out of Tehran and Iran and Israel is firing a lot of ballistic missiles, obviously they cause fatality. But the fact is, strokes cause twice as many deaths as all accidents. Diabetes is the biggest reason of causing deaths than accidents. Now, with few horrible exceptions like 9/11, the number of casualties like terror attacks is very small relative to other causes of death. Even in places that face geopolitical strife like Israel, the weekly number of casualties is lesser. So what is availability bias? Availability bias is when we see a lot of recent dramatic events, when we are exposed to a world where influencers are, giving their narratives, exposed to a heavily advertised world. Now we take decision based on what is available to us. That is why media is so powerful. Likelihood of an outcome is based on how easily it comes to mind, how familiar it is to us. So, for example, anything which is very dramatic, a building getting bombarded, your favorite cities getting bombed, all of that, it creates a lot of fear in us. These are recent events. These have been splashed everywhere. Eye-catching visuals, controversial headlines, media headlines, scandalous, eye-grabbing stuff on the media catches our attention. heavily advertised products catches attention. We are into a family where we have a father figure, a main important figure, and we've always followed him. So that our experience is narrow. Frog in the well means narrow personal experience. Familiar products we have never looked at. So we've never looked at other products. We have never delved into it, or we have never consulted an expert. So dealing with something familiar. So what is availability bias? It is basically an extension of recency bias. We get influenced by recent events, well propagated, well advertised events, and that is called availability bias. So when you have too many images and ideas, so number one thing is get up in the morning, do not look at social media. I would rather spend my 20 minutes meditating and exercising rather than looking at social media, because that is clouding and fogging. Biases is like driving with a foggy windshield. It maims your decision making, right? So the current drug addiction is social media. And let me see if I can play this video, or Amit, would you want to play this video? We are almost here coming to the end of the session. I would request if you can play this video. Let me see if I can.
Ankit, can you play it from your end?
Yes, sir.
Also trying to play. Let me see.
Oh, okay.
Okay, ma'am.
Yeah, let me play it from my side. Is my screen visible to all?
Do you want to buy shoes?
Yes.
Do you want some water?
Yes, please.
Here.
Thank you.
Can you hold this?
Yeah, sure.
Do you want to buy shoes?
Yes.
Do you want some water?
Yes, please.
Here.
Thank you.
Do you remember where we met for the first time?
Yeah, on the streets.
There's something in your eye.
Hey bro, did you see? You went viral.
What? Really?
We saw someone sweeping the streets. We took him in and we gave him some water. We asked him where he lived and he said,
On the streets.
he touched our souls, so we decided to give him a free sneaker from our sneaker parade sale. He was so happy that he started crying. Like this video so that we can continue changing lives.
Can you hold this?
Yeah, sure.
So did we get the essence of this? Are we trusting the narrative that is getting shown to us? Is that narrative fine? Are we getting a clap for it? If you liked it, please give us a clap, show us some love, give us a thumbs up. Yes. So very important of having skepticism when it comes to digital content. Is the narrative correct? Social media fuels on availability bias, herding bias, confirmation bias, and many more biases. Your social media feed, do not let it become your financial advisor. It does not know your risk appetite. It just knows your algorithm. So don't let your explore feed become your financial advisor. It does not know your goals. It just knows your algorithm. Real learning never comes from viral sources. It comes from verified sources, right? So therefore, Shubh Shanti team, can you just launch this poll? How do you think you can overcome availability bias? How do you think you can overcome availability bias? You can scan the QR code. You can use the link. The link is here, getting splashed on your screen. Is it that how can we overcome it? Option number one, to not mentally overemphasize recent and newsworthy events. To focus on long-term results and goals. Carefully research investment options and decisions before executing them. All of the above. What do you think is the correct answer? Yeah, so we've got 7 responses so far. We'll be very excited if all of you can give your responses. And we are seeing that 85% of them are saying all of the above. How about others? I need to see more responses. Please click onto the link. Just like we got 23, 27 responses for the first poll, it will be wonderful to seek your inputs. So not to overemphasize, mentally overemphasize, carefully researched, a whopping 83% says all of the above. Absolutely right. Why do we need to over-credit, give overemphasis on recent events? We need to focus on our long-term goals, right? And carefully research every investment decisions. I perfectly agree with you. It's all of the above. And you might say, Amrita, all this is fine, but the reality is hitting us, pinching us. Let me tell you one thing. And let me come straight to the point. I did an analysis of almost 3,000 plus days, 3,000 plus days, 28 years of data. Every single day I calculated the returns. Now, in this 28 years, which is from 1997 till 2025, which has all the horrid events captured, 44% of time in this 28 years, Nifty has given negative returns. So 3,000 years, 3,000 days, there were 3,000 stock market days. 44% of time Nifty has given negative returns. 10% of time it has corrected by 1-2%. There were 3-4 days where in a single day 13% correction. We have seen some crazy corrections. And there was 5% of time, literally 1 year, where the returns were almost zero. Yet, if we stayed invested, we stayed the course, we were like staying invested for this entire tenure, the returns were around 13%. Now, you might say this is a long data. We looked at data for 10 years also. In 10 years, Nifty 100 or Nifty had given almost 14% return. Yet within that 10 years, there were 3 years Nifty did not give any returns. And 16% of time Nifty was negative. And the highest correction Nifty gave was 44% negative returns. Yet if you stayed for 10 years, the returns was almost 14%. I'm going to show you different. Here are the 16 worst stock market days here on the left-hand side of your screen. Right-hand side of the screen is 16 best stock market days. We have seen that, the days when there are corrections taking place, the few days after there is a recovery also. So if 28th October 1997 was a bad stock market day, 29th October was a very good stock market day. If 10th October or 2008 subprime crisis, global financial crisis, we saw a lot of correction. There was recovery. The markets recouped as well. And the story and the saga continues. If 23rd March 2020, the peak of COVID, we saw 1 day 13% correction. 1 day 13% correction. And the next day or the next 2 days after, there were a series of recovery that took place. Markets correct, markets recover. The best returns actually comes after the bad returns. So the moral of the story is that the best stock market days and the worst stock market days are neighbors to each other. So we have to stay invested. As I've said, 10 years also Nifty has given 14% return, and yet 16% of time Nifty's returns were negative. 20 years return, 50% of time Nifty returns were negative, and yet it gave you 12-13% return. And we're talking about an index. So the power of discipline, stay invested. 1979, I vividly remember, is the year when Sensex was incepted. It was incepted on 1st April 1979 on April Fool's Day. April Fool's Day was the birth of Sensex. And 1979 was the year when Ayatollah Ali Khomeini became the supreme leader and the Iranian Revolution won. Today is the year when he is no more. Events happened, events took place, went, memories and history took place in front of us. We did not get enamored or influenced by all of this. We just continued to stay invested. Our 1 lakh transformed into 6.3 crores. From 1979, if somebody had 1 crore, he had a lot of money. But if it turns to 6 crore, that's again a lot of money. But by virtue of, timing the market, getting influenced by your recent events, you pulled out some money, stayed somewhere else in a fixed deposit, then entered once the market recovered, and we did all of that, actions. We lost out on the best recovery days. If you lose out on the best trading days, we will not make a 6.3 crore wealth. We will only make a 30 lakhs. You missed out those 40 best recovery days. Our wealth creation falls down. 40 best recovery days, our wealth creation falls down. You missed out on 1 month of good recovery days. Your wealth creation was not 6 crores, it was only 60 lakhs. So it's up to us to be Mr. Glum, or it's up to us to be Mr. or Miss Happy. So, to end, behavioral bias, all that can be taught in a lecture, in a session. It has to be experienced. We have to ask ourselves, is our thinking being triggered by system one, or it is being motivated through system two? Is our thinking calculation correct? Is it emotional? Awareness is the best step towards understanding that beyond all the calculations and financial theory. Awareness is very important. The fact that you're aware of 4 biases, while there would be 200 biases, that itself is the first step towards wealth creation. Second is, please embrace goal-based planning. That if you have a goal that I'm going to retire in 10 years down the line, I need 10 crores of wealth kitty. Currently, I have 1 crore. How do I make the balance 7 crores? That's where Shubh Shanti team will help you out. They will help you understand what are your expenses, what is your income stream, where can you cut down your expenses, where can you reduce your EMI, where can you be focused towards achieving that goal. There could be enough distractions, enough market noise. Have your luck, just like, we encourage our children. You want to be an engineer, you want to be a doctor, start studying. It does not matter till 9th standard, your grades were bad, 10th standard, 11th standard, mein sudhar jao. Have a goal. You want to crack your civil services, have a goal. Similarly, have your goals. That this is the amount of money I need during my retirement. This is the amount of money I need to have a nice, lavish wedding for my child. And this is how, in a disciplined manner, I'm going to save. Assets, do not get fixated with, any asset, because no asset class could be equity, gold, silver, small cap, large cap, whatever. No asset class continues to occupy the numero uno position. No asset class continues to occupy number one position. Some years it is the year for gold. So 2018 was the year for gold. 2020 was not the year for gold. 2022 was the year for gold, but 2024, maybe it was a mid average performer. Small caps did very well in 2023. 2025, they haven't done well. But today, this year, small caps, the smaller companies are poised to show better returns. Silver similarly did fantastic in 2020. It was not the year for silver for 2021, 2022. So the way this data has been presented is the number one investment options are shown first. The worst investment options are showed at the bottom. So it is, following a descending order, which are the assets that are ranked number 1, number 2, number 3, number 4, so on and so forth. And the moral of the story is winners rotate. So therefore, believe in asset allocation. Understand your risk appetite, your goal, and then allocate your money. It is not what product. You should ask Shubh Shanti team, what for? How long? What is my risk appetite? And therefore, embrace a journey of allocating money into different investment options, which are called asset classes, which will enable you to achieve your goals. And I'm a big fan of perpetual SIP. Perpetual means I don't have an end date for an SIP. Maybe I will not suggest that to you, but at least sign up for a 10-year SIP. You should tell Sandeep ki, nahi, one SIP of mine, 5,000 rupees or 10,000 rupees will be for 10 years. I will not trouble you. And I am the live example. I've done an SIP for 2,000 rupees. Today, that 40 lakhs, nobody can take it from me until and unless, somebody knows my bank account or my mutual fund ka password. Nobody can take it. This is something that I created because I was disciplined, and most importantly, I suffered from forgetfulness and amnesia. Continue your SIP. Do it for 10 years. Do not break it. And in the end, how much ever we know about, Sharpe ratio, trailing ratio, GDP, IIP, all this is theory. Human beings take decisions emotionally. They use those emotions to ratify their decisions. So it is the decisions taken emotionally and logic being used to ratify and validate those emotional decisions, which means that psychology affects decision making more than any financial theory does. So these are the biases we discussed. Loss aversion, we feel the pain of losses more intensely than the pleasure of equivalent gains. Loss hurts. Herding bias, we have a tendency to follow the crowd rather than conducting independent analysis. We follow the trending stock, the trending scheme, the trending sector. Confirmation bias stems out of our ego. We want information that supports our belief. We ignore information that is contradictory. Availability bias is, taking decisions based on heavily advertised recent and dramatic events. With this, I come to the end of the session and pass the baton back to Sandeep. Over to you, Sandeep. Thank you so much.
Amrita, this is a lot of food for thought, and that's great. While we are absorbing this, I would like to open the chat box to all the participants. Please do put in your questions. And Sandeep, I'd request you to moderate the questions and answers, please. And Amrita could answer.
Yeah, sure. Thank you, Amrita, for the wonderful session. As we wait for the questions, I would like to start. I would like to ask something on confirmation bias. What are two, three practical questions every investor can ask themselves to challenge their own views before making a big decision?
So one is that, am I looking at information? So you should ask yourself that, am I looking at information just because it is supporting my belief system, right? That is one. Or would I give this advice to someone else even if I was not emotionally attached to it? So the way to ask this is that, okay, I like this particular investment. Maybe I'm a big fan of BPS. Now, would I suggest that to someone if I didn't have emotional attachment to it? Or am I taking a decision just because I like it? Can there be something more? Can I look at the red flags as well? So I would always say follow the middle.
Okay. There's a question that if there is one key takeaway or one mindset shift that you would want us to take a, what would that
Yeah.
be?
So the one that I shared in the end, the psychology affects decision making more than any financial theory does. Financial theory is great for people like me as an educator to give lectures. End of the day, one takeaway is, please, I would say 75-31 rule. Your SIPs should be minimum for 7 years. You don't need 100 schemes. You might need 5 schemes or maximum 10 schemes. So 75 means 7-year SIP minimum. You don't need 100 schemes, maximum 5 schemes, 3 asset classes, equity, debt, and gold, and one fund, one scheme. 75-31. Do not let your emotions shroud and cloud your investment decisions.
Okay, so I have a question. I don't know if you can take that up, but I'll still try. What is your guidance for the current times? So basically, what they want is a market outlook. Mm.
Yeah. So I think all your indices, Nifty, 50, Nifty mid cap 150, Nifty small cap 250, the large caps, mid cap, small cap indices have all corrected. So they are, in terms of their P ratios, much below their 5-year average Ps, which means that the valuation seems attractive. Secondly, India has always been considered to be an expensive market compared to the world. Today, that expensiveness has come down. Third is that Indian companies, be it a larger company, smaller company, or a mid-sized company, are poised to show better profits for the next FY26, which is the next year, FY27, which is the year of that financial year which is going to start, and for the next year as well. So, which means that I would rather get into equity through. I would definitely invest into equity. But to be on the safer side, I would invest into into equity through a staggered mode. I would rather do a 6 months or a 9 month systematic transfer plan. Put my money into a liquid fund or a debt fund and systematically transfer it into an equity.
Great. Just to add to what Amrita said, while all the indices have corrected, one must also note the earnings that have come in the last quarter and the earnings which is supposed to come this quarter. By market cap, one should also analyze what is going to be the PEG ratio, not only the PE ratio, and that will give them a very good insight as to how should they look at investing. We can discuss obviously more on this one-on-one, but just to tell you how should you think, I think this is a great time to start investing for sure. Yeah. So I have another question. How often should I realistically review or adjust my portfolio during uncertain times?
Now, see, first thing is that has your financial goal changed? Has your time horizon changed? Has your risk tolerance changed? If these three things haven't changed, then as I've said, uncertainty was there, will be there, and will be there in the future also. So was there, is there, and will be there in future as well. All that, doomsday, conspiracy, apocalypse, uh, uh, is there a probability? Well, I'm not Baba Vanga, neither I'm Nostradamus. Correct? So your reasons to readjust should be, has your financial goals changed? Has your time horizon changed? Has your risk tolerance changed? And has one asset class, in your investment has become too large or too small versus your target allocation? Or is your fund deteriorating fundamentally? Or do you have some liquidity expenses? So I think these are the three things that we need to look at. So the best way is, I would say, as I've said, you need three funds. One is equity, one is debt, one is gold. And depending on your risk appetite and your time frame, you can allocate.
Sure. I think we are running really short on time. There are 4, 5 more questions, but maybe we'll take them one on one if possible. So I would like to invite Smriti for the closing remark.
Yep. So I'd like to thank Amrita a lot because this has been a very eye-opening session, especially about the past market recovery data post any major global events. So that gives me quite a bit of clarity for sure. But become how it has become our primary source of information right now. So that was shocking to me. Now, I'm sure we all are feeling much calmer now, seeing these data and, after the session, and we are ready to make much more logical rather than emotional investment decisions. I urge each one of you to take out 1 more minute, please, and share your feedback for the session today. The link is in the chat box. You've stayed with us for quite some time. Thank you so much. Before we sign off, a quick reminder that Shubh Shanti Wealth Navigator is a monthly commitment to your financial education. New topics, new experts, and new learnings are coming your way every month. So please join the SSW Navigator WhatsApp community to stay updated on the upcoming webinars. The link is in the chat box now. You can also share it with friends, family, colleagues, anyone who you think is interested in learning. Thank you for being such an interactive and wonderful audience today. Stay focused, stay invested.
Thank you, Amrita, from Team Shubh Shanti, for taking out time today.
Thank you so much. Thanks.
We have both the links in the chat box. The Shubh Shanti community link to stay updated, and we have the link for the feedback form for today's event. Please go ahead and fill the forms. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.